Interested in learning about price to earnings or PE ratio? This metric gives investors a quick evaluation of a stock. It's a very common metric that helps you understand if the company is currently over or undervalued in the market. Hey, welcome to Lord Finance, the channel centered around your financial education to help make you a better investor. Be sure to subscribe to the channel. PE ratio is a valuation metric that compares the stock's current price to its earnings or profit. It tells you how much of a premium you are currently paying in order to gain exposure to that company's profits. The price to earnings ratio can be used to help understand whether the market is currently placing a high or low price on that stock based on how much money and profits the company is generating. In general, stocks with a low PE ratio, something around 10, would imply the stock is currently cheap, whereas stocks with a high PE ratio, like 50 or greater, implies the price is expensive relative to the profit that it makes. Let's have a look at how you can calculate the PE ratio. The formula is the price per share divided by the earnings per share. The output from the PE ratio calculation will result in what's called a multiple. If you ever hear somebody referring to a stock's multiple or earnings multiple, this is what they are talking about. Let's do a quick example here. A hypothetical company, Buck's Bike Shop, currently has a stock price of $60 per share and has an earnings per share of $3. To find the PE ratio, we divide $60 by $3 to find that Buck's Bike Shop has a price to earnings ratio of 20 times. What this tells us is that the market is currently valuing the shares of Buck's Bike Shop at 20 times the amount of their yearly profit. So if you were to buy shares in Buck's Bike Shop, you would be paying 20 times the amount that they generate in profit for the year. This ratio also implies that it would take 20 years at current price and profit levels for Buck's Bike Shop to make enough money to pay back all the shareholders in full for their shares. PE ratio really shows its strength when you use it to compare different companies within the same industry. Let's compare two companies here, Buck's Bike Shop and Stan's Scooter Shop, both of which provide transportation, so we can consider them to be the same industry from before. We already know that Buck's company has a PE ratio of 20 times. Now for Stan's Scooter Shop, they currently have a price per share of $75 with an earnings per share of $5. You may be inclined to think that Buck's Bike Shop is a better value because the share price is only $60 versus the $75 for Stan's Scooter Shop. But share price alone does not tell the full story. When we calculate the price to earnings ratio for Stan's Scooters, we find that the stock has a PE ratio of 15 times. Even though Stan's Scooters has a higher price per share, they are also generating more earnings for the shares outstanding. What we see is that when we compare the two companies and apples to apples with PE ratio, we find that Stan's shares are actually a better value since the company is more profitable. Even though Stan's Scooter shares are $15 more expensive, they actually give you the right to more profits. This is really the key to understanding what PE ratio tells us. You should know that the price to earnings ratio is really only useful when comparing companies within the same industry, since different industries will have different standards when it comes to PE ratio. It would not make sense to compare McDonald's PE ratio to Amazon's PE ratio, for example, since expectations and growth rates within the restaurant sector are very different than the expectations for a technology company. McDonald's might see more consistent profits but at a lower growth rate, whereas Amazon's profits are expected to grow much faster. It would be a much better idea to compare Amazon's PE ratio to another tech company, like Apple, to get an idea on the valuation of each of those companies. Then compare McDonald's to another restaurant, like Taco Bell. With that being said, remember that using PE ratio for comparison is really only useful for companies that operate in similar markets and similar industries. How do you use PE ratio to evaluate a company? Let us know your process in the comments below. If you found the video helpful, give it a thumbs up and subscribe for more, and we'll see you in the next one.